Your friend can't stop talking about it. The stock he picked 6 months ago is up 40%. He shows you the app, the green number, the exact date he bought in. He sounds like he's finally cracked something everyone else missed. What he doesn't mention, not once, are the other 3 picks sitting quietly below it. Down 8%, down 15%, one he already quietly sold at a loss and stopped mentioning entirely. Nobody really brags about those particular numbers. This is exactly why the real, honest odds behind stock picking almost never come up truthfully in casual, everyday conversation. People talk about their winners constantly, in great detail. They talk about their losers almost never. And that one-sided silence has been quietly shaping the entire debate for decades now. Index funds carry a genuine image problem in most casual conversations, and it's not hard to see exactly why. There's no story to tell at a dinner party about buying a diversified basket of 500 companies. Nobody feels clever for doing it. It doesn't come with a moment of conviction, a bet against the crowd, a feeling of having spotted something everyone else missed. It's automatic, unglamorous, and quiet by design. Picking individual stocks, on the other hand, has genuine, undeniable emotional pull built right into it. There's a real story attached to every single pick, a specific reason you believed in it, a genuine moment of being right when everyone else doubted you, the specific satisfaction of watching a company you personally chose actually perform well. That feeling is completely real and legitimate, and it's exactly why the natural appeal of stock picking never really goes away entirely, no matter how many times someone hears that index funds tend to statistically win over time. But here's the actual question worth carefully separating from that emotional pull, because the two things genuinely aren't the same at all, even though they feel connected. This video isn't asking which strategy feels more exciting or satisfying to personally pursue. It's asking which one actually wins more often, over real time, using real, measurable financial outcomes rather than a feeling or a good story. Those are two completely different questions entirely, and quietly conflating them is exactly why this debate stays so genuinely muddled for so many people, year after year. Excitement and actual performance don't have to move together at all, and in this specific comparison, they very often don't. That's exactly where the real data becomes genuinely useful, because it settles a question feelings simply can't answer on their own, no matter how confident anyone feels while making a pick. Not whether stock picking feels more rewarding in the moment. It often genuinely does, and that feeling is completely real. But whether it actually, reliably produces better financial results than simply owning the market as a whole, tracked honestly across real years, real funds, and real professional managers with every possible advantage and resource available to them. The answer to that specific question is measured constantly, published regularly by independent researchers, and almost never makes it into the casual, everyday conversations where stock picking gets discussed the most enthusiastically. People share their wins. Researchers track everyone, winners and losers alike, without any personal stake in which story sounds better at a party. Here's the specific number that ends most casual, everyday arguments about individual stock picking, once people actually see it laid out clearly and honestly. Every single year, without fail, S&P Dow Jones Indices publishes something called the SPIVA scorecard, carefully tracking exactly how many actively managed funds actually beat the specific index they're supposed to be competing against. This isn't merely an opinion piece, and it's certainly not a hot take from some finance influencer with a following to grow and a product to sell. It's a real, independently published dataset, updated regularly and consistently every year, using audited, verifiable fund performance data going back a full 25 years. The 2025 results specifically were genuinely, unambiguously stark. 79% of all actively managed large-cap U.S. equity funds underperformed the S&P 500 that specific year, according to S&P Dow Jones Indices. That made 2025 officially the fourth worst year for active large-cap managers in the entire 25-year documented history of the SPIVA scorecard's records. And that's genuinely not even the most discouraging part of this entire dataset. The longer the specific time horizon actually gets, the noticeably worse the numbers get for active management as a whole, without exception. Over 3 full years, 67% of all active large-cap funds underperformed the index. Over 5 full years, that specific number climbs further to 89%. Over 20 full years, it reaches a genuinely striking 93%. Read that final statistic again, quite slowly, because it's genuinely worth sitting with for a moment rather than skimming right past it. 93% of professionally managed large-cap funds, run by trained people who do this full-time for a living, with dedicated research teams, active trading desks, and institutional resources most individual investors will simply never have access to in their entire lives, still failed to beat a simple, low-cost index fund over 2 full decades of consistent investing. This isn't a story about a small handful of simply unlucky managers picking the wrong stocks during one particularly bad year for the market. This is a persistent, decades-long pattern, showing up consistently year after year, in nearly every rolling time period ever measured by this ongoing research. The exceptions genuinely do exist, and some individual managers do occasionally beat the market in certain specific years. But they're exactly that, exceptions, not the reliable, repeatable norm. The broader investment industry's own marketing often tends to quietly suggest to potential clients considering active management. Here's why this specific data point matters so enormously for the individual stock-picking debate happening right now, in living rooms and comment sections everywhere. These are professionals, full-time, paid specifically, often quite well, to beat the market as their entire job description. If the vast, overwhelming majority of them genuinely can't reliably do it with every conceivable institutional advantage imaginable available to them, dedicated analysts, real-time trading access, decades of formal training, that raises a real, uncomfortable question worth asking yourself honestly. What odds is an individual, part-time investor picking their own stocks around an unrelated full-time job actually working with in direct comparison to all of that institutional firepower? That gap between institutional resources and actual measurable results is exactly where this video is headed next, because the underlying reasons behind it matter just as much as the raw numbers themselves. So why exactly does this happen, decade after decade, consistently, to people who are genuinely skilled, well-trained, and thoroughly well-resourced for the job? The first answer is fees, and it's the most mechanical, unavoidable part of the entire explanation, showing up regardless of skill. Actively managed funds charge meaningfully higher fees than index funds because paying skilled analysts, running ongoing research, and trading frequently all cost real, substantial money every single year. Those fees get subtracted directly from returns annually, whether the fund actually beats the market that year or not. Over just one single year, that difference feels genuinely small, almost negligible. Over 20 full years, compounding turns a seemingly modest annual fee gap into an enormous, hard-to-recover difference in final account value, simply because a smaller number compounding steadily for decades produces a meaningfully, sometimes dramatically smaller final result. The second answer is considerably harder to fix with a simple lower fee structure: consistency over time. Beating the market once is genuinely quite achievable, and plenty of individual managers do it in any given single year. Beating it reliably, year after year, decade after decade, requires being right about the uncertain future more often than the market's collective, aggregated pricing already reflects at any given moment. Markets absorb brand new information remarkably fast, almost instantly. Any obvious advantage or insight gets priced into share values almost immediately by thousands of other participants doing the exact same research at roughly the same time. The third answer is the one almost nobody discusses honestly, even though it distorts the entire public conversation: survivorship bias. The specific funds and individual stock pickers people actually hear about are disproportionately the ones who happen to win. Funds that underperform badly over time tend to quietly close down or merge into other better-performing funds, disappearing entirely from the data people casually see years later. The winners stay visible and get talked about constantly, at length. The losers simply vanish from the conversation entirely, which significantly distorts how skilled stock picking actually looks from the outside, to someone forming an opinion based on what they happen to see online. Here's where this connects directly and quite clearly back to individual investors watching this video right now. Professionals face all three of these exact same headwinds while still holding real institutional advantages working in their favor. lower trading costs, faster access to information, decades of formal training and experience. Individual retail investors, meanwhile, face those exact same three headwinds without any of those meaningful institutional advantages backing them up at all. The fee gap is often genuinely, meaningfully smaller for a retail investor picking their own individual stocks without a fund manager's salary attached to every trade. But the consistency problem and the severe survivorship bias distorting what actually gets discussed online apply just as strongly to individual investors, if not considerably more so, given how much louder and more visible winners tend to be than losers on social media specifically, in a way that skews perception badly. None of this is theoretical or hypothetical in any way. There's a real, extensively documented, decade-long public test of exactly this question, and the person who ran it happens to be one of the single most respected, successful investors alive today. In 2007, Warren Buffett made a genuine public bet worth $500,000 of his own money. His specific claim? A simple, low-cost S&P 500 index fund would outperform a hand-picked basket of hedge funds over 10 full years, measured honestly after every single fee and expense had been subtracted. Hedge fund manager Ted Seides of Protégé Partners accepted the challenge directly and personally selected 5 specific funds of funds he genuinely believed could beat that index over time. The bet officially ran from January 1st, 2008, all the way through December 31st, 2017, a full decade with no exceptions or adjustments. It began right at the start of the worst financial crisis in decades, which briefly gave the hedge funds an early, temporary lead in the standings, since their more defensive positioning genuinely cushioned the initial market crash somewhat better than the plain index fund did in those first turbulent months. Then the market recovery happened, and it simply wasn't close. By the very end of those full 10 years, Buffett's chosen S&P 500 index fund had gained a cumulative, verified 125.8% overall. The 5 carefully chosen hedge funds, selected specifically because someone genuinely believed they could beat that particular number, instead gained 21.7%, 42.3%, 87.7%, 2.8%, and 27% respectively. Every single one of them lost to the simple index, and most of them lost badly. It's worth being genuinely precise about what this particular bet actually proves, because it's remarkably easy to overstate its meaning. This wasn't specifically a bet about individual retail stock picking. It was a bet about professional, actively managed investing versus low-cost passive indexing, tested using hedge funds rather than individual stock choices made by a retail investor. That distinction matters quite a bit, and stretching this one bet into a sweeping blanket statement about every individual stock picker would go further than the actual evidence genuinely supports. But the underlying mechanism this bet demonstrates so clearly is exactly the same one covered earlier in this video, just at a different scale. The hedge funds Seides carefully selected charged substantial fees on top of their active trading activity. Those fees compounded steadily against them for a full decade, in the exact same way fees quietly erode returns for any actively managed strategy, whether that's a hedge fund, a mutual fund, or an individual picking their own stocks. And skilled, well-resourced professionals, given a full 10 years to prove their specific approach, still genuinely couldn't consistently overcome that basic mathematical headwind working against them the entire time. Buffett ultimately donated his full winnings to Girls Inc. of Omaha. Seides, for his own part, has since been publicly candid about the loss, openly acknowledging afterward that the bet illustrated something real and uncomfortable about the sheer difficulty of sustained outperformance, even for serious, well-credentialed professionals with genuine expertise. This is precisely the same underlying pattern from the SPIVA data covered earlier, just playing out here in one single, dramatic, decade-long real-world test that anyone watching can actually go verify for themselves independently. None of this in any way means individual stock picking is universally pointless. And it's genuinely worth being fully honest about that important nuance before this video goes any further. Real, well-documented, genuinely verifiable exceptions absolutely do exist. Some people bought early into a single, specific company, held on patiently through years of real volatility, and ultimately ended up with genuinely extraordinary financial results. Long-term, concentrated bets on companies that later became recognizable household names have created real, substantial, life-changing fortunes for real, specific individuals over the years. These particular stories aren't fabricated in any real way, and they genuinely aren't rare in the sense of literally never happening at all. But they're genuinely rare in a different, considerably more important sense. Predictability in advance. Nobody identifying these specific opportunities beforehand ever had a reliable, repeatable method for confidently separating the eventual winners from the thousands upon thousands of similarly promising companies that quietly failed or simply stagnated for decades without anyone ever noticing at all. The people who succeeded this particular way genuinely weren't operating from a repeatable, reliable system anyone else could confidently apply going forward with any real, meaningful assurance of similar results. They were making a concentrated, genuinely high-conviction bet, and in these specific, widely publicized cases that happened to survive, it worked out spectacularly well. This is exactly where survivorship bias returns once again, and it's genuinely worth naming directly, clearly, one more time before moving further on. For every single early investor in a company that eventually became a massive, career-defining success story, there were far, far more people making similarly confident, similarly concentrated bets on other companies that quietly disappeared entirely without a single trace left behind. Those particular stories simply, quietly, don't get written about afterward, ever. Nobody makes a documentary about the concentrated position that went silently to zero somewhere. The winners get remembered and endlessly, warmly retold at every dinner party for years afterward. The losers get forgotten almost immediately, and that stark asymmetry in what actually gets publicized distorts how common these specific success stories genuinely seem from the outside looking in. None of this is meant as an argument that concentrated stock picking never ever works under any circumstances. It's an argument that when it genuinely does work out, it's remarkably difficult to distinguish real, repeatable skill from pure, simple luck after the fact, using only the specific stories that happened to survive and get told publicly afterward. That distinction, genuine skill versus pure luck, something identifiable clearly in advance versus something obvious only in hindsight after the fact, is exactly what all of the data covered throughout this entire video has been carefully measuring the whole time. Think back for a moment to that same friend from the very beginning of this video, still proudly showing off his 40% winner right there on his phone screen. You now know exactly what that specific moment was actually missing. Not a lie, exactly, or anything intentionally deceptive. Just a genuinely incomplete story, edited down to the one number that felt good enough to share out loud with someone. The three quieter, more embarrassing losses sitting below it were never mentioned once. Not because he was deliberately hiding them, but because nobody ever really brags about the specific picks that simply didn't work out. That's survivorship bias in its most personal, everyday form, playing out in a single conversation instead of a research report. So does that specific realization mean you should genuinely never pick an individual stock ever again? Not necessarily, and this video was never trying to argue that outright. But it does mean the entire decision deserves a considerably more honest framing than the simplistic, smart, disciplined people pick stocks, cautious, timid people just buy index funds narrative that gets repeated so often. The real underlying question is actually narrower than that broad framing suggests. How much of your total portfolio can you genuinely, honestly afford to risk on an attempt that history and decades of data suggest is far more likely to underperform than to actually beat a simple, low-cost index fund? Are you doing this because you've done real, substantive research and genuinely find the process itself intellectually interesting? Or because you're chasing the same exact excitement your friend was actually describing earlier? And critically, is this happening with a small, deliberately contained portion of your overall investments, while the clear majority stays safely in the low-cost index funds the actual data consistently favors? Answered honestly that way, the two options genuinely stop being enemies at odds with each other. Someone can absolutely hold index funds as the reliable foundation of their entire portfolio and still pick a small handful of individual stocks with money they've deliberately decided they can genuinely afford to lose entirely, treating the whole exercise honestly as entertainment and personal curiosity rather than a serious retirement strategy they're counting on. That's a fundamentally different, far more honest decision than quietly betting your entire financial future on being the rare statistical exception the data throughout this video says is genuinely uncommon. So where does this specific comparison actually leave you right now, sitting with whatever you're genuinely invested in today? Maybe the data in this video was a genuine relief to hear, solid confirmation that the boring, automatic index fund strategy you already quietly chose was actually the statistically smarter move the entire time, even if it never once made for an interesting story to tell at a dinner party. If that's genuinely you, there's absolutely nothing wrong with boring. Boring, based squarely on decades of consistent evidence, tends to reliably win over time. Maybe you're someone who genuinely, honestly enjoys the process of picking individual stocks, and this video didn't talk you out of it, and it was never really trying to in the first place. If you're doing it with a small, deliberately contained portion of your overall portfolio, treating it honestly as a hobby rather than your entire retirement plan resting on it, that's a perfectly reasonable, well-informed way to enjoy the process while still letting the actual odds work in your favor where it genuinely counts most. This channel exists specifically to run the real, honest numbers on the financial debates most people settle with a strong personal opinion instead of an actual data set. If today's video genuinely helped you see this specific decision more clearly than before, subscribing means you won't miss the next one in this series. Before you go, I genuinely want to know honestly, where does your own actual money actually sit right now? Mostly in index funds, a genuine mix of both, or leaning heavily toward individual stocks? Drop it in the comment section below, along with why specifically, if you're genuinely willing to share that with everyone. I read every single one, and this conversation is far from finished.